Bears, bulls, surges, and slumps. Those are all words used to describe the stock market.
Some find they want to get off the roller coaster in retirement. We'll talk about some stock market alternatives right now on Retiring Today.
Welcome to Retiring Today. If you're like a lot of people, you might watch the stock market. You see it go up, you see it go down, and you wonder, how will that affect my retirement vision? That's what we want to talk about today. The good about the stock market, the bad, and how to put the two together to meet your goals. I'm here with Loren Merkle. He's a certified financial fiduciary and a certified financial planner. And Loren, let's go back to 2020. Let's not stay there too long, but let's go back to 2020 because just a quick look at my notes. The fastest bear market ever on record. The Dow and the S&P saw the worst first quarter ever. March of 2020 was the most volatile month on record. It was a wild ride.
It was a wild ride. There was a few firsts that we saw last year, but it wasn't the first that we wanted to see, and it caused a lot of pain. It caused, in some cases, some panic, and it caused a lot of heartache for many people. I remember back in March of 2020, you guys probably remember this really well, the Dow Jones set a record. It was down 34% in 22 days alone. And then what we saw is some days the Dow Jones was down 3,000 points in one day, and then the next day it was up 2,000. So the emotions, a lot of people's emotions, especially if you're in retirement and you're taking income from your investments and you're seeing your investments that you need income from do that kind of movement, have that kind of movement, or you're right before retirement thinking, am I really going to be able to retire in 2021 when I want to? Or am I going to have to postpone that? So a lot of people's emotions were riding that stock market roller coaster last year as well, which is not an uncommon phenomenon, Molly. Every time we go through a recession or a bear market where we have some drastic moves, a lot of people's emotions do ride that roller coaster with the stock market. And that's not necessarily a good thing, especially when your lifestyle is dependent upon that stock market.
Well, yeah, and then 2020 ends at a record high for the S&P 500. So we do know, this is what we do know about the stock market. And I only say this because I've heard you say it. It will go up and it will go down. I mean, that's the one certainty we know about it.
Yeah, a lot of people ask me, what do I think the stock market's going to do in the near future? And I say, the one thing we know it's going to do is it's going to go up and it's going to go down, which is true. And what most retirees and pre-retirees are looking for is how do they not have to have their lifestyle go up and down with the stock market? And that's part of the premise of the investment planning portion of the Merkle retirement method. And what you should be looking at as you're in that red zone to retirement or already retired is how do you create a portfolio where you can do anything that you want to do, of course within your retirement plan boundaries, but how can you do what you want to do in retirement regardless of what the stock market does? You need to beat taxation because most people's retirement monies still have to be, taxes still have to be paid. You want to beat inflation and you want to grow it on top of that. But you don't want to have to depend, you don't want to have to say, I can't go on this trip or I can't get this for my grandkids because the stock market's down by 30%. Nobody wants to go through that, so how do you do that?
And I've heard, Loren, some talk about the stock market being overvalued. Is that true, or how do we kind of wrap our minds around that?
That's interesting because the people have been saying the stock market is overvalued now really since about 2015. And if you think back to 2015, that's when we had a real first hiccup in the market since 2008. And so people were saying stock market's overvalued, it's overvalued, we're going to see this correction or bear market come into play. And we didn't have that until 2020. So there's a lot of metrics, a lot of technical metrics that people use to value the stock market. And by traditional metrics, yeah, the stock market is overvalued. But one institutional investor told me this a long time ago, I'll never forget it. He says the stock market has no memory. The stock market has no memory. Regardless of where it's been before, it can keep going. And there's a lot of factors that will influence the stock market. The valuation of the stock market is one of those metrics you can use to try to predict. But in predictions, you always at some point will get them wrong.
Okay, so let's talk about the stock market because I think you've seen, obviously, it do really great things for people's retirement, and if not used correctly, do bad things for retirement. But you have a story to tell us about how this can happen.
Well, the stock market can be an incredible growth engine. Where people go sideways with the stock market is in retirement, you still use this stock market as an income engine instead of the growth engine like it's designed. And we have a story, Sean, one of our retirement planners, Sean and I were talking about this the other day, and he was telling me a story of somebody he knew back in 2014. This is, again, people were saying the stock market's overvalued. We're going to go through a bear market. Protect yourself. So this couple, they heeded the warning and they went completely to cash. They had roughly about $500,000 at that time in 2014, January of 14. And here it is. This is 2021, and they are still not back in the market. Because if you look at the timeline of the Dow and the S&P 500 since 2014, when were they going to get back in? Because there were a few hiccups along the way, especially in 15, but there was nothing that was substantial enough as far as a decrease in the market for this particular couple and many others to feel comfortable to get back into the market. So 2015 went by, 16, 17, 18, 19, 20, and here we all at all-time highs, and the S&P 500 since January of 2014 is up 112%. So their portfolio, their 500,000, they're thinking, and a lot of people think over a 10-year period, their portfolio should double, and they're still sitting at 500, somewhere 500, 550,000, where they could have had a substantially larger amount that they could use to go towards their retirement. And this is one of the things we see people do is they will make knee-jerk reactions many times, go to cash, but then it's a matter of how do you get back in, when do you get back in, and many times there's never really a great time to get back in.
Yeah, I've heard you say it's not timing the market, it's more time in the market.
Yeah, and there's been study after study that's been conducted to say if you just stay invested in a diversified, well-balanced portfolio, you are going to fare much better than if you try to make these types of timing decisions. So within our overall plan, one of the things we do for our families is we try to create this recession-resistant portfolio where their lifestyle will not be impacted severely by a big downturn in the market. And then in addition to that, we put in some tactical moves so when the market does go down, they're not fearful of that. They're actually smiling because they can take advantage of it with some of these tactical moves that we have in place for this type of an event.
And Loren, I think people are familiar with measuring the risk in a portfolio, maybe on a scale of 1 to 10. You sit down maybe with a couple and say, what's your risk comfort? What if they have two totally different risk comforts?
Right.
But I think the way you guys do it, or way the retirement planners do it here, is you look at their actual portfolio and you talk about it in real numbers.
Yeah, we talk about it in real numbers because one of the most important aspects of creating a recession-resistant portfolio, or a portfolio that you feel comfortable with when things are at its worst, when things are really ugly, is to make sure everybody is on the same page as far as how would your portfolio react given a really poor market. So we take a look at a family, let's say Mr. and Mrs. Jones, they have $1 million portfolio. We say we go through a really poor 12-month period in the market, your $1 million would lose $200,000. Mr. and Mrs. Jones, how do you feel about that? Realizing nobody likes to lose money. Right, that's not an exciting thing for anybody.
But you are in the stock market. There is some risk involved, yeah.
Yeah, but when you're taking risks, so when the market does poorly, the portfolio will go down. It's just a matter of how far does it go down? Are you comfortable with it? And probably the biggest question that needs to be answered is, will that impact your retirement vision? Will it change the trips that you want to take? Will it change the legacy plans if you have a living legacy, or if you want to help your grandkids through college? Is it going to impact all of that in a negative way? And if the answers to those questions are yes, now you know that you can fix it. And that's why right now is a really good time to try to determine how much risk are you taking in your portfolio in a very clear and concise way. Because if you're uncomfortable with that amount of risk, or if it's going to negatively impact your retirement vision, now you can change it when the market's up here. When we go through a March, that is the absolute last time you want to alter your risk. At that point, if you can, if it makes sense within your plan, you want to hang on to it and allow the market to come back, allow your portfolio to come back, and then make adjustments. But like what we see is you go through that bad ride, everything gets better again, the market comes back up, the portfolio comes back up, and then people don't make adjustments, right? Because everything's good again. But we know we're going to go through that again. On average, we go through recessions about every 5 years. So over the course of your retirement, you're going to have many negative stock market experiences. So it's better to be prepared going into something like that as opposed to going through the panic type of reactions, which are natural, but it's what you want to try to avoid when we do see those events.
Yeah, that's the true definition of that recession-resistant portfolio. So we've only been chatting for about 8 minutes, and we've already talked about a few scenarios and how portfolios could react. But what if you got a chance to talk to a retirement planner for 15 minutes about your portfolio and your recession-resistant retirement? Well, here's an opportunity for you. You can go to merkleplan.com right now, and you can get on the calendar of the advisors here at Merkle Retirement Planning. You can schedule your 15-minute retirement checkup. But don't go anywhere. We have a lot more to talk about when it comes to the stock market. We'll talk about some of the other investment options if you don't like that stock market ride when Retiring Today continues.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us April 27th at the FFA Enrichment Center in Ankeny at 6:30 p.m. for a complimentary workshop, Journey to Retirement. What you can learn at this workshop will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
Retirement looks a little different for everyone. Retirement with government benefits requires a little extra homework to fully understand the terms used, calculation of benefits, and options you may have. Join Loren Merkle Wednesday, April 28th at 11:30 for a complimentary online workshop on government benefits. Register today at merkleplan.com. That's MERKLE plan.com.
Welcome back to Retiring Today. We're talking about the stock market. It can be a wild ride, and it's not for everybody. So what are some of the other alternative investments to consider? I'm here with Loren Merkle. He's a certified financial planner and a certified financial fiduciary. And Loren, let's get right to some of the other things to consider to at least make maybe a portion of your portfolio or part of your portfolio. And one of them is CDs.
Yes, these are alternatives to the stock market. And it's not that you would want to have all of your money outside the stock market, but maybe you do, right? It's a little bit different for everybody. Most people are familiar with CDs in some fashion. They're issued by a bank. They're guaranteed, in most cases FDIC insured. And they're going to provide some kind of return based on the maturity of that CD. And typically the longer the maturity, then the higher return that you're going to receive. So if the bank, if you're promising to the bank you're going to leave your money there for 12 months, maybe they'll offer you 0.5%. But if you say, bank, I'm going to leave that money there for 18 months, maybe they'll offer you 0.75%, right? So the longer that maturity, typically the higher yield you're going to receive on that investment. People like CDs because they are guaranteed, plus they have the FDIC, so they're guaranteed by the bank, and then they have the FDIC insurance on top of it. Historically, CDs have worked real well within a portfolio, but with today's rates, most people are trying to stay away or find an alternative to CDs because when you invest in a CD, you are losing money. You're losing money on versus taxation, and you're losing money versus inflation, because if your money's not in an IRA, like most CDs, then you have to pay taxes on whatever paltry yield you earn that year. So whatever that yield is, you're still paying taxes on it, and then inflation is still growing at 2 to 3%, and you're losing money on that as well. So we call the CD or the bank type of investing right now in this environment safely losing money.
Right, because we just looked it up, something less than 1% on a 3-year CD.
Yeah, to prepare for this show, we looked at through bankrate.com. You can check it out as well. I think the highest 3-year CD that I saw out there was a little bit over 1%. Okay. And a lot of them were significantly less than 1%. It's just the nature of where bank rates are right now based on where interest rates are. So there will be a time that changes, but most people are concerned about right now, how do they get the most out of their money? And bank products right now are not the best place for a lot of people's retirement savings.
Another thing to consider are bonds. What's kind of the right now state of bonds?
Yeah, bonds right now are really interesting. In a lot of ways, bond investing is even more difficult than investing in the stock market because there's so many different moving parts to it. So you have to make sure you're really savvy. And if you're not really savvy, like most people in the bond market, they're going to invest with bond mutual funds. But with bond mutual funds, What takes place is interest rates go up, which means that bond prices go down, which means that you could actually find yourself losing money in bonds as interest rates go up. So as of late, we've seen some interest rate increase movements over the next couple of years. We're probably going to see them go up at some point. They can't go down much further.
Right.
So there's only one direction to go, and that's up at some point, which means bonds could lose money in that market, but it is a good investment and alternative to the stock market if it works for you on your retirement plan, on your investment plan to help accomplish that retirement vision. I wouldn't throw bonds out the window, wouldn't throw CD, I wouldn't throw any of this stuff out the window. It's just the right portion with the right mix to accomplish what you're trying to accomplish.
And something that gets a bad rap, but again, if used properly, for the right scenario, could be advantageous is an annuity.
And annuities can be a good fit for some people as well. The thing with annuities is there's a lot of different annuities. And if we were to dig deeper into bonds, there's a lot of different types of bonds as well. Just with annuities, a lot of people are not familiar about the different types of annuities. They just weave them all into that same basket. And so there's two different types of annuities we want to offer some clarification on here. One would be the fixed index annuity. This is a product that has evolved over the last 2 decades. It really came on the scene a couple decades ago, and is a lot of retirees, a lot of pre-retirees are deciding to use these in this interest rate environment, because the whole premise behind it is we want to earn, or you want to earn better than what the banks can pay over the course of the life of the investment. You are offered a guarantee through the insurance company. So these fixed index annuities are not FDIC insured. They're backed by the full faith and credit of the insurance company. But we'll just give you an example here of how this particular one works. And even with the fixed index annuities, there's a lot of different types of those as well. But this gives you an example, and this is a hypothetical example, so this is not any guarantee that you can get this type of performance, but it'll give you an idea of the construct of a fixed indexed annuity of this shape. So with this particular example, in 1998, somebody invested $100,000, and you can see that the red line is the fixed indexed annuity. And we're going all the way through 2019. So starting from 1998 to 2019. The orange line is what you're very familiar with, which is the S&P 500. And so you can see over the years how the S&P 500, it goes up and it goes down. So the S&P 500 is not guaranteed. You know you can lose money in it. The fixed index annuity is backed by the full faith and credit of the insurance company. So when the S&P 500 loses, you get a 0% rate of return. And you're happy because you didn't lose. When the S&P 500 goes up, then you participate in that up. So you get a percentage of that up, and that percentage that you get will change from time to time, okay? But you get some of the up with none of the down. And so the benefit of this type of strategy, or what a lot of people find appealing, is you can participate in the positive of the S&P 500 and not participate in the downside. Now, one of the negatives of a fixed index annuity is there are some time constraints, just like a CD, meaning that if you promise to leave your money with a bank for 3 or 5 years, then you do that. Otherwise, you pay penalties getting out of it most of the time. With the fixed index annuities, most of them will require you to keep the money underneath with that insurance company for a 7-year period of time. 10-year period of time is pretty common. There are some early withdrawal provisions without a penalty, but it does vary per insurance company as well. But the whole idea of this is a bank alternative where it can produce some higher upside potential and still guarantee principal. And it's what a lot of pre-retirees and retirees are looking at right now with the current interest rate environment.
Also, pre-retirees and retirees looking at, here it says in my notes, MYGAS. I don't know what it stands for, but I know that you do.
MYGA. So that's a MYGA. That's just another type of annuity. This one's really easy because it is an alternative to a CD. It works very similar to a CD, but instead of being backed by the bank and FDIC, it is backed by the insurance company. And it works very similar from a standpoint of with the insurance company, you're promising to leave that money there for a period of time, let's say 3 years. Each year, they're going to pay you a stated rate of return, or a 5-year period of time. And again, just like CDs, the longer period of time you promise to leave the money with the insurance company, typically the higher yield you're going to receive. Now, if we compare the yields, usually with these types of investments through the insurance company, you can get a higher yield than what you can at the bank. So we said the 3-year through bankrate.com is a little over 1. There's offerings right now through different insurance companies, same 3-year time frame, but you can get a little over 2. So more than twice, or about twice the amount that you can get at the bank. So that is appealing for some people for a piece of their money as well. In these types of environments where the stock market is just out of control up, out of control down, and the bank isn't paying us much, we have to think outside the box. We have to think outside the box to preserve your principal, but yet still deliver the income that you need. And some of these alternatives to the stock market and the banks can work really well as a portion of your overall portfolio to deliver that income and principal protection.
We've been talking about a few concepts, a few alternatives to the stock market, but when it comes to a retirement journey, there's a lot more to talk about than just income. There's healthcare, there's legacy planning, there's more with income and investments. So we're going to tell you about an opportunity to learn about all of those things in just a moment. But first, here's our Ask the Advisor question. This is a question that came to us and it says, if inflation increases because of the money that's been printed by the Fed, will there be better conservative investment options? Loren will answer that question and much more when Retiring Today continues.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us April 27th at the FFA Enrichment Center in Ankeny at 6:30 p.m. for a complimentary workshop, Journey to Retirement. What you can learn at this workshop will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
Retirement looks a little different for everyone. Retirement with government benefits requires a little extra homework to fully understand the terms used, calculation of benefits, and options you may have. Join Loren Merkle Wednesday, April 28th at 11:30 for a complimentary online workshop on government benefits. Register today at merkleplan.com. That's MERKLE plan.com.
Welcome back. This was our Ask the Advisor question for this episode. And the question was, if inflation increases because of the money that's been printed by the Fed, will there be better conservative investment options? This is the man who knows the question, the answer to that question, Loren Merkle. He's a certified financial planner and a certified financial fiduciary. Loren, what would you say to that?
I would say most probably that's going to take place. And regardless of whether inflation increases because of all the money that's being printed and flooded into this economy, or inflation increases for any other reason, more, conservative options and the rates that you're going to receive off of those conservative options are probably going to increase, which most people would deem better. Now, one of the things that we're going to see as interest rates increase, inflation increases, that when inflation increases, that means your spending power decreases. So you might be able to get a 3% CD, but it's going to cost you 20% more at the pump. Right, things like that. Your daily costs of living are going to increase. That's what inflation is. So this is all something that has to be put within your retirement plan of how do you combat inflation? How do you use these different investment alternatives as they evolve throughout the course of retirement and evolve with this economy as this economy changes? Because what you're using today may not be the right fit for you 5 years down the road. What investment options you're using today may not be the right fit for you, or probably won't be the right fit for you 10 years down the road, not only because your life changes, but also the economy and the investment solutions that are appropriate for the economy at that time are going to change as well.
Okay, so we're talking about these alternative investments, and I got to ask you, what about Bitcoin? Should I put my money in Bitcoin, Loren?
I was waiting for that question. We're getting so many questions on Bitcoin right now just because it's everywhere, right? Everybody's talking about Bitcoin, and we've seen such an increase on the price of Bitcoin over the last 12 months. Everybody wants a piece of that kind of increase.
Yeah.
But do you want a piece of that type of risk?
No.
Because when investments go up like that, they can also go down like that, and we saw that with Bitcoin. We saw the incredible rise of Bitcoin. We also saw the incredible deflationary aspect of Bitcoin, and then we saw the rise again. So historically, Bitcoin has been a roller coaster. We're talking about roller coaster of the stock market. You can magnify that by investing in Bitcoin. You can use Bitcoin, and now many people can use Bitcoin as a part of their portfolio in a couple different ways, which was different than even 3 years ago. So you have different alternatives how you can use it, but you want to be very careful. Use it as the speculative type of your portfolio, the speculative part of your portfolio, and then you can't get hurt too bad. But you really want to understand what you're investing in, like any of your investments, and make sure it's appropriate for you, what you're trying to accomplish, and then that can be an overall piece of your recession-resistant portfolio.
Getting to and through retirement is a journey. It's a trip that can be 20 or 30 years long, and it takes some planning. You don't just want all of a sudden one day not show up for work without a plan to get you to and through retirement. So here's a great opportunity to start thinking about your retirement, your journey to retirement. It's our online workshops. We've got them online, and then we've also got them in person. See, we're back in person. People can come in if they want to. You get that knowledge from the retirement planners in person, or they can do it from the comfort of their home. So you can go to merkleplan.com to sign up for the online or in-person workshops. Loren, what will people learn?
People are going to learn about how to construct a retirement plan. There's 5 guiding principles that go into most people's retirement plan. When you retire, you're going to want an income plan. When you retire, you're going to need a tax plan, a healthcare, long-term care plan, legacy plan, and of course an investment plan to help navigate through this roller coaster stock market so you can create successfully a recession-resistant portfolio so your lifestyle doesn't have to go up and down with the market. And we're going to talk about these different topics through the eyes of John and Sue. John and Sue, we lay out for you their very specific retirement goals, what their retirement vision looks like, and then strategies that they will use to accomplish their retirement vision. And then through the eyes of John and Sue, you can visualize your own retirement and hopefully take away some very specific strategies from that workshop that you can implement almost immediately to help improve what you're trying to do from your own retirement vision.
And we mentioned we have an online option or an in-person option, and people should know that we have a nice big room and they can spread out.
Yeah, it's definitely socially distanced, and that's why we're also offering that online workshop. From the comfort of your own home, you can see John and Sue's retirement path and some of the strategies that they're implementing and take in a lot of this same information. So whatever's right from you, from the comfort of your home, or if you want to attend a class in person, they're both there as an option.
And we'll also continue to talk about retirement and your retirement vision and how to make it come to life on this show. It's Retiring Today, and we thank you for watching.
When planning a big trip, do you like to look up points of interest, read restaurant reviews, or map out how to take the scenic route? You may spend days or even weeks getting ready for a week-long vacation. What about the 20 or 30-year journey that is retirement? Join us April 27th at the FFA Enrichment Center in Ankeny at 6:30 p.m. for a complimentary workshop, Journey to Retirement. What you can learn at this workshop will help you plan for the most exciting journey of your life. Register today at merkleplan.com.
Thank you so much for watching Retiring Today. We hope you've enjoyed the show.
See you next week.